Suzette Cullen, and Genevieve Vaughn, author of the book Forgiving, a Feminist Criticism of Exchange. The Wings Sound logo is from Libana's album A Circle is Cast. I'm Wings series producer Frida Worden. This is the Women's International News Gathering Service.
Don't you
You're
love
listening
that
to
concept? My God, that's so incredible. These ladies, that's Wings, Women's Internet News Gathering Service, and they come up with some of the most humane, socially conscious stuff out there. I mean, I love it. But speaking of humane and socially conscious ideas, we have some before us in Finding Our Fit. So I'm going to turn the floor over to the star of Finding Our Fit, Susanna Calvert. So without further ado, this is WRWK, Midlothian, Virginia. We're here to serve you. Please enjoy our programming and contribute when you can. I figured out today, Susanna, it costs us $28 a day to run the station. So if anybody wants to select a day, I'll give them, they can have the first Tuesday in the new month or the second Tuesday. You know, people can join up for their day of the month. It's a new way of, or a whole week if they're generous. Anyway, so enough of my diversions. I know you have things to talk about. So, Marketia and Susanna, take it away. I will back out. Oh, by the way, the phones are not working today. Sorry to say, but anyone who wants to make a donation, that would be accepted.
Well, thank you, Ron. And what a great way to make a difference for the station for only $28. That sounds like a real bargain. You can sponsor a day for $28. Probably people spend more on their coffee than that most months. So good afternoon, everybody. And thank you, Ron. I'm Susanna Wu-Pong Calvert. This is Finding Our Fit. The purpose of our show is to help us find our place in our crazy and beautiful world. And in so doing, we will enrich our world and create a brighter future for everyone and everything, especially Earth. I'm also the founder and executive director of the Foundation for Family and Community Healing, whose mission is also to help everyone find our fit through mental, emotional, and relationship resilience skill education. Check us out after the show at healingedu.org. We did this program to help us make sense of this crazy and beautiful world we live in so that we can choose the more beautiful side. Often we might tend to focus on the crazy side of our life, forgetting that the other side is where we can find and create opportunity, wisdom, and healing. In Finding Our Fit, we focus on learning, growth, and how to become wiser and more resilient by adopting a healthier relationship with ourselves, everybody, and everything. It's important to embrace both that yin and the yang, both the challenging and rewarding parts of our lives, to create balance and conditions for healing. It's a practice that we choose every day. Today's topic is one of those things where I know there's an upside, but it just feels viscerally like only downside to me. And here is my confession. I hate dealing with money. I have sort of a detente or stalemate in my relationship with money. We have an agreement. I work hard to earn money and to save money and find someone to invest it for me. And otherwise, I expect money to be there and to behave and not to create problems for me or worry. And so other than that, I am pretty much hands off with money because it's just something that I do not enjoy dealing with. Fortunately for me, that strategy has worked pretty well my whole life. I've had enough money to take care of myself, even in my widowhood, and enough to start the Foundation for Family and Community Healing, to get it started and launched, or at least that's the plan. So money has been mostly a blessing for me, and I am just so fortunate and grateful. And I have also had a lot of discipline in terms of my saving and spending, but also a very healthy respect for this idea of money and what it can and cannot do. You can probably tell from my tone that it's sort of the same type of relationship I might have with something like, a wild animal like a tiger, that might be living in an adjacent property. I treat it with respect, keep my distance, know my boundaries, but I also realize that there are certain times of the year that tiger might wander into my yard, and I'm going to have to deal with it. Just like any other thing that I really don't want to have to manage on a day-to-day basis. Now, that's probably not a fair analogy, but I'm just saying that that's how it feels to me. And with money, that tiger comes into my yard every tax season, whether I want it to or not. I cannot just pretend it's not there. And I've only been able to delegate that duty a few tax seasons in my whole life. Otherwise, I have had to deal with that tiger, unfortunately, on my own, and making sure I don't get bit. Well, thank God that we all have different affinities and passions, and that while I have want to keep a healthy distance and respect with money, that there are others that actually love this stuff. Others have passion for it and are well versed and knowledgeable. And it's even their mission, maybe, to help others with their money and, yes, even their taxes. So today on Finding Our Fit, we have a unique challenge for one such person to see if she can help me feel less avoidant and feel less ick about the whole tax thing and money thing. And I have a feeling that she's going to give us all a tiny dose of excitement and anticipation and even a sense of confidence about money and taxes, which is good because I filed an extension this year. So it's not too late for me to get fired up on this subject. So I'd like to welcome to the show Marketia Wright, JD, LLM, tax professional, and also foundation board member, for which I am eternally grateful to her, to discuss today's topic, which is getting past the ick of taxes, the ABCs of the Internal Revenue Code. So, well, Marketia, welcome to Finding Our Fit. Thank you for joining us today.
Thank you for having me. It's always a pleasure to come on and talk about taxes. A lot of times people's eyes will glaze over. So I try to make it as fun as possible with real life examples and scenarios and throwing a little bit of my wit in there when I'm explaining things. So but I appreciate you guys for having me.
Well, and I just love that, this is something that you love to talk about, you love to do, and I'm exactly 180 degrees on that. But I always love talking to you, Marketia, and I'm grateful for what you and people like you offer to those of us who are avoidant and about this topic, and you always do so with so much style and intelligence, integrity, and expertise. So thank you for dialing in from Texas, really,
Yes.
to help us learn about our taxes and how to be in better relationship with that. So why don't you tell the audience a little bit about Marketia and why you do this work?
So I learned in college. I went to the University of Alabama for undergrad, Roll Tide. I learned in college that while I don't really care for people, I like helping them. So I'm not big on like interacting with people unless I'm helping them. And so when I graduated from college, got my first big girl job, I started working with the state of Texas in public service, worked in the food stamp office, helping to process applications for food stamps, Medicaid, and TANF. I had always wanted to go to law school, but I kind of put it on the back burner. And finally, on my 30th birthday, I said, all right, Marketia, it's time to put up or shut up. Either you're going or you're not. You're 30 years old. It's time to, sit on a pot or get off. And so applied, packed up my life in 9 suitcases and moved to Massachusetts for 3 years. The East Coast, your weather is very disrespectful, but I did enjoy my time on the East Coast. Graduated in law school, fell in love with tax. And we, used to study various amounts of law, different laws in law school. And one of the things that I came to realize was that I liked what we call code-based law. There's a code, the property code, the bankruptcy code, the tax code, code-based law. There's an answer. I can find an answer. There's a yes, there's a no. You may have to dig for it a little bit, but you can get an answer. So I fell in love with tax law. We were required to take federal income tax as a requirement to graduate, but I didn't stop there. I took federal income tax 1, 2, gift and estate tax, taxation of business entities, participated in the ABA tax challenge. I just fell in love with all things tax. When I graduated, I came back to Texas, worked again for the state in the unemployment office, basically holding hearings for those people who apply for unemployment and may have been denied or granted it for whatever reason, and somebody didn't agree with it, so they had to hold a hearing. They appealed a decision. So I was a hearing officer, and basically I had to conduct those hearings and then issue a decision based on the information and evidence I gathered. Realized then that I didn't want to stop with going to law school, because I guess I'm a masochist. Went back to law school for a second degree, which is my LLM, and that one focused mainly in taxation. Well, not mainly, but it focused in tax law. Got an opportunity to go work for the federal government, working with the IRS, auditing people, and realized that I did, in fact, love working for the IRS, and I did love everything tax, but not so much the job that I was doing. By the time I got to taxpayers got to me, I was pretty much, for lack of a better term, ruining their lives, because a lot of times I had to tell them, hey, you owe this huge tax bill. And, me trying to help them, saying, this is how you can avoid this in the future. I realized I wanted to get to them before it got to that point. Let's help you prevent these huge tax bills by educating you on the IRC, what you can and can't do, the ins and outs of the IRS, things that I can say, and, letting people know that it's not as scary as it looks. It has a bad name, but there are resources and there are tools that you can use in order to help you during that 4-month period that everybody hates every year. So, and here we are today, tax professional, connoisseur, tax nerd, whatever you want to call it. So, yeah.
Well, thank you for sharing that, Marketia. And whenever you talk about your background and what you love to do, I just sit here and think, well, in at least this way, you're about as opposite as you can be from me, and which to me that means it's a great superpower and a total mystery. And so to me, like, you might as well be from Mars. But I am so grateful for you and others like you, as I said. So this is WRWK 93.9 FM, Finding Our Fit. I'm Susanna Wu-Pong Calvert, here with Marketia Wright, JD LLM, tax professional extraordinaire, discussing getting past the ick of taxes, the ABCs of the Internal Revenue Code. And our phone lines are down, even though it's scrolling across our screen. But if you are on Facebook and would like to pop something into the chat, I know you have tax and money questions for Marketia. We would love to hear from you. So let's just get into this, Marketia. Why don't you give us a little primer on types of taxes and tax returns and what we need to know, about that and the tax return season.
Okay. So I focus mainly on individual tax returns and maybe some small business returns. And so the one thing that I always tell people is that where you would start for an individual in making sure that your taxes, that they're pulling out enough money throughout the year, is, especially if you're a W-2 employee, is check your W-4. So your W-4 is a withholding certificate that you would have filled out anytime you got a job and you're a W-2 employee. And when I say W-2 employee, that means your employer is basically going to pay your taxes for you. The other type of employment, it could be self-employment or 1099 contract work. In those instances, your employer will not pay your taxes. You are required to pay your taxes. So first off, you need to know, are you a W-2 employee? Or are you 1099? And obviously, if you're self-employed, you know that. And so if you're a W-2 employee, one of the things that HR is going to give you when they're giving you your onboarding paperwork is a W-4, and this is the employee withholding certificate. And on that form, it's going to ask you your filing status, and it's going to have single, married, with married filing jointly, married filing separately, or head of household. What gets a lot of people in trouble, particularly single people, is that they think even though they're single and they live by themselves, or they may have a partner, like, I'm the head of my household. Yes, so I'm going to check head of household. For your filing status, for tax purposes, you are not the head of your household without a dependent. If you are not married, then you are single. And so your filing status is going to be single. For those who can check head of household, you must have a dependent. And notice I say a dependent and not necessarily a child. Yes, children are considered dependents, but there are other ways that you can have a dependent. The most common one is if you care for your parents. They live with you, you take care of them, you're paying more than 50% of their expenses, you can claim them as a dependent. Another caveat with parents is that if you are taking care of your parents and you're still meeting that criteria of taking care of them, they do not necessarily have to live with you in order for you to claim them as a dependent. For any other person that lives in your house, there's a list of criteria that you have to meet. They don't necessarily have to be related to you, but if they meet that criteria and you're paying more than 50% of their expenses and they're living with you, you can claim them as a dependent. So it's possible for you to claim an adult as your dependent. So that's why I say dependent and not necessarily children. But in order to claim head of household, you must have a dependent. If you have no dependents, and unfortunately, sorry, furry animals, furry sons and daughters don't count. If you have no dependents, you are not the head of your household for tax purposes. So when you're filling out that W-4, you need to check single if you are not married. And then with the other two, we have married filing separately and married filing jointly. Most people are going to do married filing jointly. There are some tax situations that may call for you to file married filing separately, but you may miss out on some tax benefits, but it's really based on your tax situation. I always encourage people, if you have any questions about your tax situation, about what's more advantageous for you to choose as a filing status, sit down with a tax professional and say, hey, this is my tax situation. What is the best thing for me? And usually what's going to happen is for the people who are married. With single people, you're not really going to have a big tax situation that is going to, cause any trouble unless you're divorced and, you have children and you're trying to figure out, okay, can this child be claimed this year? They're going back and forth. But for the most part, people who are going to have those issues about what to file, what filing status is more advantageous for them, is going to be those who are married or if you have dependents with a person and you're divorced. The next thing about the W-4 is it has a section on there where you can claim your dependents. So you can put, I have 3 dependents that I'm going to be claiming and go from there. The issue that a lot of people run into is, okay, when you tell them what your filing status is on a W-4, your employer is going to hold out taxes, federal withholding, based on your filing status and if you have dependents. And to give you an example of what that looks like, if you were single, your standard deduction is, I believe, for 2023, let me pull it up 1 second. Standard deduction for 2023 for a single person is $13,850. And what the standard deduction is the government telling you the first $13,850 you make out of your gross income, we're not going to tax it. So we're going to give you the standard deduction. Now, for head of household, that jumps from $13,850 all the way to $20,800. This is almost about a $7,000 difference, give or take. And so when you put the incorrect filing status on there, your employer sees, okay, they're claiming head of household, even though they didn't put any dependents. We're going to hold out their taxes under the assumption that when they file their taxes next year, their deduction is going to be $20,800. So we don't have to hold out as much for them to meet their tax liability because they're going to have this elevated deduction. Well, guess what happens when you go to file your taxes and your filing status must be single instead of head of household? Well, they have taken it out based on the fact that they think you're going to get $20,000 in deductions as opposed to $13,000. So that $7,000 difference will be added to your gross income. And guess what? They may not have taken enough taxes out. And so now you're stuck with either a significantly smaller refund or possible tax liability that you owe after filing your taxes. So I always tell people, start with your W-4. Look at your W-4. Make sure that it's filled out correctly. If you are someone who can claim head of household because you have dependents, I don't necessarily tell people to claim the dependents on the W-4 because, again, they're going to be like, okay, you're going to get this $20,000 standard deduction, and now we're anticipating that you're going to get tax credits. So we may not hold out any money because we're anticipating a deduction and we're anticipating tax credits. You may not have any tax liability. And so what happens is you claim it, you get there, you don't have any tax liability, but you're not getting that bigger refund that you used to because they didn't withhold any money out. And a lot of people they when they receive refundable tax credits, they don't understand what that means, and so they're expecting these huge refunds, and it's like you only get what you pay in unless you're eligible for the refundable credits. If you didn't pay in anything, you're not going to get anything back. So starting with that, know your filing status, make sure your W-4 is filled out correctly. For those parents who have children who are teenagers, one of the things that you need to watch out for is that the child tax credit changes once a child turns 17. 16 years old and below, you can get up to $2,000 per child. And I think the max is 3 children. So you can get up to $6,000 in a tax credit. Once that child turns 17, that tax credit for that $2,000 drops drastically down to $500. So that's a $1,500 difference. And so if you are claiming 3 dependents and they're saying, okay, we're going to take it out based on your head of household, we're going to take it out based on you claiming 3 dependents, and one of those dependents has turned 17 in that year, well, that $6,000 that you may get up to has now dropped drastically down to $4,500. So you're like a $1,500 difference, and that could really matter. If you have a higher tax liability this year, maybe you got a raise. Like a lot of things can go on, and so you're counting on that tax credit, but it's been severely reduced. So it's very important that when your children, to keep up the age of your children, especially when you have teenagers, to go in there and update that W-4 and just remove, like, that 17-year-old at this point, don't even try to claim. You can still claim them, but when you're listing things on the W-4, just list the 2 that are under as opposed to that 3rd one, if that's the situation. Okay. And that's just I can keep going on and on, but if you need to interrupt me with another question, go ahead.
Okay, well, let's just pause because I want to get the lay of the land. So you, I think, clarified and gave some really valuable information about your W-4 and the status you claim and what the standard deduction is and how the child tax credit works. And so let's also just back up a bit, because there's what you're talking about is for your individual tax returns. That what is it called? The
1040. Yeah,
1040, right? The
Yes.
1040. And but there's also different types of tax returns. Like, so if you have a business, then you would file a different type of tax return, right?
Well, what'll happen is that depending on how your business is designated, you may file, especially if you're getting to like the small businesses that are beyond what we call a Schedule C. They may file on 1120, or they may file other ones. For the ones that I deal with specifically, you file a 1040, but you're attaching a Schedule C to it because that's how you're going to report your income. And then that gets me into the 1099 workers and the self-employed people. So you would still file a 1040, but what you would attach is what we call the Schedule C. And that's how you would report your earnings from 1099 contract work or self-employment. And so on that form, you would basically report your income. If you have the name of a business, or the name of the business, this is your people who drive an Uber, Lyft, or if you yourself, let's say you have a yard business, landscaping business in the summertime on the side, this is how you report that income. But this is also how you would report your expenses. And so what happens is you fill out your Schedule C, you put your income in, you do your expenses, and then they transfer that over to your 1040 under the income section. And you still are eligible for the standard deductions, and you still may be eligible for other tax credits. But the caveat with self-employment or 1099 work is that now you are required to pay a self-employment tax. And the reason why you are required to pay a self-employment tax, which is an additional tax that is different from income tax. So you have your income tax and then you have your self-employment tax. They're different. You are required to pay a self-employment tax because when you have W-2 employment, when you look under your withholdings, you see federal income tax withholdings, and then you see Social Security and you see Medicare. So when you have W-2, you're paying into that. Well, self-employed people they have to pay into that as well if they want to claim those benefits later on in life if they're eligible for them. So how they pay that is through the self-employment tax, which is basically the makeup of the Medicare and the Social Security tax. And so it's very important to understand that the self-employment tax is different than the income tax, and the self-employment tax is based on the amount, the income that you report that you have made. So there are some deductions, additional deductions that you can receive when you report 1099 or self-employment income, but you will have to pay an additional tax. And what happens is that you can zero out your tax liability, but you can still owe taxes because you owe that self-employment tax. And the only way to reduce your tax liability for self-employment tax is to, one, make direct payments, or two, be eligible and receive refundable tax credits. And I know I've mentioned that before, but tax credits are basically credits that the government will issue you if you're eligible for them that will reduce your tax liability dollar for dollar. They're different from deductions because deductions will help reduce your gross income to determine your taxable income. So there's non-taxable income and there's taxable income. You report all your income at once, and then the government goes in and says, okay, based on these deductions, this amount is taxable and this amount is not. So you have your taxable income. And then from your taxable income, they determine your tax liability. And so in your self-employment and 1099 income is added in with any other gross income you may have. So like if you have a W-2 job and then you do Uber or Lyft on the side, they'll add all that income together, and then they'll give you your deductions, and then they'll come up with your taxable income. They'll have your income tax liability, and then they'll have your self-employment tax liability as well. And so the only way to reduce that self-employment tax is through direct payments and refundable credits. And so if you have W-2 employment and, let's say you have dependents and you have tax credits, those tax credits that are non-refundable are going to reduce your tax liability, and you can have zero tax liability. And then what will happen is the payments that you made from your W-2 employment can reduce your self-employment tax. And if you're eligible for any refundable credits, that can reduce it as well. But if you don't have any of that because you're self-employed and you didn't pay any taxes throughout the year, even though you may not have any income tax liability, you can and will have self-employment tax liability. And you can pay that self-employment tax throughout the year, just like other W-2 employees, but you'll have to set up an account with irs.gov, and you'll have to go in and make federal estimated tax payments throughout the year. You can make them quarterly, and you just go in there and you pay what you think the tax would be based on that income. There are worksheets and tables that you can access through the IRS, the Schedule SE, which is the Schedule Self-Employment. You can go in there, you can plug your income in, and you can do the worksheet, and it'll give you an estimated amount of taxes that you need to pay quarterly. And so that way you don't end up with a huge tax bill at the end of the year.
Okay, so this is WRWK 93.9 FM. I'm Susanna Wu-Pong Calvert, here with Marketia Wright, JD LLM tax professional, discussing getting past the ick of taxes, the ABCs of the Internal Revenue Code. And we'd love to hear from you listeners. Our phones are not working, but you can still type something into the Facebook chat. I bet you have tax questions and stories here from Marketia, and we'd love to hear from you. Okay, so let me just summarize where we are, Marketia. You give a lot of information in a short period of time. So let me see if I can just summarize. So we've been talking about basically the individual taxes, the 1040, and that there's some business owners with small businesses that can still use the 1040 to file their taxes by using Schedule C.
Yes.
And there they will report all of their income. And the income from self-employment or 1099 work is also reported there. It contributes to the gross income, but in addition to paying income tax on that and your other income from your W-2, you also have to pay the self-employment taxes, which makes up the Social Security and Medicare payments that your employer would have paid for your other income.
Yes.
So, so you have those two forms of tax liability, and deductions will reduce what your gross income is. So whatever you say your total income is, you can reduce that amount with deductions.
Mm-hmm.
Then there's also tax credits that can come off the other end in terms of reducing how much tax you have to pay.
Yeah. So
I summarize that?
your deductions help determine your taxable income. So you are reporting gross income, you deduct whatever deductions you're qualified for, eligible for, and then that produces your taxable income. This is the amount that we're going to tax you on.
Okay, so the gross income and then minus deductions gives you your taxable income, and that's where
Correct.
they determine,
They determine your tax liability from your taxable income. Yes.
Yeah, in the old days, it was the chart, and you.
Yes. Yeah. And then when you get to tax liability, that tax liability can be reduced dollar for dollar with tax credits.
Tax credits. Okay. And so before you were talking about the child tax credit.
Yes.
So after you determine how much you're supposed to pay in taxes.
Yes.
You can reduce that amount with a tax credit, and it would, of course, take out anything you've already paid for it, right?
Yes.
So if you're a business owner, what kind of tax credits might be available? What are the ones that people tend to miss?
So for a small business owner, one of the things that you will get is the qualified, well, until the TCJA expires, is the qualified business adjustment. And that will expire in 2025. But when they changed it in 2017, they took away a couple of things, but they added some things as well. And one of the things they added was QBID, and that's the qualified business income deduction, which basically gives you a deduction based on the amount of income that you report. If I try to explain it, I will lose you. So just know it's a deduction that you get for being a business owner. And then for some tax credits, it just really depends on what type of business you're in. And it's something that you definitely want to speak with your accountant about. As far as the business credits, I'm not well versed in business tax credits. I have a really good friend who's an accountant, and this is all he does. And so whenever I'm dealing with someone who has a business or a Schedule C, and I'm looking to see what tax credits available are, I send him a text message. I call him on the phone. I'm like, this is their business. This is what they're doing, and they can tell me. And on the flip side, he calls me when he's dealing with an individual attorney about the tax credits that individuals can receive. Some of the tax credits. Sorry, my earbud is coming out. Some of the tax credits that individuals can receive are things like, well, first off, let me start here. There's two types of tax credits. There's refundable, and then there's non-refundable. And they're kind of like what their name says. Refundable, once the tax liability has been reduced to zero by the tax credit, if there's anything left over, they refund it to you. Non-refundable, it'll just get you down to zero. And if there's anything left over, you don't get it. So a good example of that is the child tax credit. The child tax credit is non-refundable, meaning that if you are eligible for up to $2,000, but your tax liability is only $1,500, it'll reduce that $1,500, and then that other under $500 stays there. The additional child tax credit is refundable, meaning that if it's $1,500 left over, you're eligible for the $2,500. It'll reduce the $1,500 and refund the $1,000 back to you. Another popular refundable credit is the EITC, which is the Earned Income Tax Credit. Another one is the premium tax credit. The premium, basically with the ACA, a tax credit or you paying taxes back. It can be a tax credit or an additional tax. And what happens with the ACA is when you sign up for it, you estimate your income, and they will pay your premium based on the income that you report to them. At the end of the year, they send you a nice form, a 1095-A, and they say, this is how much we paid. And when you add it to your return, based on the income, they will say one of three things. They will say, hey, you zeroed out. We didn't pay too much. You didn't underestimate too much. Or they'll say, hey, you reported more income than you actually had. So because you reported more income than you actually had, you were entitled to a bigger premium payment. So since we didn't pay more, we're going to give this back to you as a refundable tax credit. Or they will say, you underreported your income. You were eligible for this amount, but you told us that you made this, so we gave you this other amount that you weren't eligible for. So since you weren't eligible for that amount, you have to pay it back in the form of an additional tax. Now, when you do have to pay it back, it is capped based on your income. An example of that is, let's say they overpaid by $2,500. They're not going to tax you on the full $2,500. At most, you may pay like $600 or $700 back. So it is capped. So even the amount that they overpaid, it is capped at some point based on your income. And then we have education credits. Education credits, there's two of them. There's the Lifetime Opportunity Credit, and then there's the American Opportunity Credit. American Opportunity is a refundable credit. Lifetime Opportunity is a non-refundable credit. And depending on which one you qualify for, there's some criteria that goes along with them. They can reduce your income as well. American Opportunity can only be used 4 times in your lifetime because it has a refundable portion of it. Once you use it those 4 times, you cannot use it again. Now, you can try to use it again, and the IRS may not catch you. But when they do catch you, they will bar you from using tax credits. So yes, tax credits are a privilege, not a right. So if you abuse tax credits, the IRS can ban you or withhold you or take away the privilege of you using a tax credit. And it has happened mainly with people who are getting child tax credits or additional child tax credits that they're not eligible for because that is not an eligible dependent for them. So be wary and be very careful about the tax credits that you claim if you're not eligible for them, because you can be barred from using them because they are a privilege, not a right. Some other tax credits are the residential energy credit. You put on solar panels on your house, energy efficient windows, basically trying to reduce your carbon footprint. You can receive a tax credit for that. And so what happens is that the non-refundable tax credits are applied first. And if your tax liability is reduced to 0 with non-refundable tax credits, what happens is anything that you paid in from W-2 or your 1099-Rs, any tax that you may have paid out from any payments, that gets refunded back to you. If you're eligible for any refundable tax credits, that gets refunded back to you. If the non-refundable do not fully pay out your tax liability, then they go into the payments you made. And this is usually done through your W-2 federal withholding, or if you receive a pension or any type of retirement and they pull taxes out, they'll use that as well. They're considered direct payments. So they'll go into the direct payments. And if direct payments and non-refundable wipe it out, if you're eligible for refundable credits, you get a refund on those. The third one they use is the refundable credit. So they have 3 tiers that they go through in order to reduce your tax liability to either 0 or get you a possible refund. And that's how your refund is composed of your tax liability. Then they take away the credits, they take away the direct payments. And then they say, if there's anything left over, you get a refund. If there's nothing left over, you zero out, you balance out, or you know what, we've applied all the payments that you're eligible for and you still owe taxes. And usually what happens for the people in self-employment is that they can only reduce their self-employment tax by direct payments or by refundable credits. And if they don't qualify for refundable credits or they have no direct payments, the non-refundable credits can zero out their tax liability, but they still have that tax payment for self-employment tax.
Okay. So let's back up a bit, Marketia, because just sort of going back to the bigger picture about who has to file a return,
okay,
who has to pay, why do you have to pay? Can you just talk about those things for
yes
minutes?
So there are income limits for what you have to pay. And normally what happens is you look at the standard deduction for the year. If you are someone who is working and you have not made enough that exceeds the standard deduction for your filing status, unless they took taxes out of your money, there's no reason for you to file because you're not going to have any tax liability because you're not going to have any taxable income. So like, for example, this year, the standard deduction for a single person is $13,850. If you made $12,000 this year, when you plug that $12,000 in, and then they put in the standard deduction, is going to zero out your gross income. So you're going to have 0 taxable income. You cannot have tax liability with no tax income. It's like there's no interest without principal. So without taxable income, there's no tax liability. And so a good rule of thumb is look at how much money you made. And then if you didn't make enough money, did they take taxes out? Because there are some jobs where they're going to take taxes out regardless. And so what you do is you file just to get that money back. And that usually happens with students or people who are not working full time. You also want to file because you could possibly be eligible for a refundable credit, even though you didn't make that much money. But normally, this rule of thumb is if you did not exceed the standard deduction, there's no reason for you to file because you're not going to have taxable income. Now, for people who receive Social Security and pensions, I always get the question when I'm preparing taxes is, at what age do I have to stop paying taxes? Well, it's not really an age thing. It's more of an income thing, whether your income is taxable. So generally, Social Security income is not taxable, generally. However, if you have additional income outside of Social Security, a portion of your Social Security can become taxable. And the most you will pay tax on your Social Security is up to 85%. Up to 85% of it can become taxable, depending on your tax situation and how much extra additional income you have. And so what happens is that, you'll have someone who's receiving Social Security. They may go get a part-time job because they're bored or whatever, and they may exceed that income threshold. And now a portion of their Social Security has become taxable. Well, because they didn't think they were going to be making that much money, they were like, oh, I'm only going to make about $20,000 this year. It's not going to be that big of a deal, blah, 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 blah. They don't have taxes taken out of the W-2 income or taxes taken out of the Social Security income, but now they're hit with a tax bill because the standard deduction only eats up so much. And so now you have anything less than $11,000, which is the 10% tax bracket right now, anything less than that, you're still going to have to pay some taxes on it, and you may not have the tax credits to eat it up. So it's very important to, especially if you're receiving Social Security, to look at those numbers of how much you can make. And if you know that you're going to make more, or if you know that you're going to get a side job and you're probably going to make more than anywhere from $10,000 to $15,000, depending on your filing status, have them voluntarily take money out of your Social Security. You can have them do that, and make sure that they're taking money out of your W-2 income. Now, there's some jobs where, they're like, oh, we don't take taxes out, and, you're responsible for paying taxes even though you're a quote unquote W-2 employee. Well, on your W-4, there's a section under section 4C, that says extra withholdings, and they will take out extra money per pay period. You can have them take out additional money per pay period if they're not taking anything out, or you feel like they're not taking out enough. As far as an age limit on when you have to file, when you get a job. Most people get jobs at 15, 16. I think the first time I filed taxes was in 2000 for the 2001 tax year. I filed taxes. I did a 1040 easy form. I'm aging myself because you had to go back to the post office to get your tax forms. When the first time I filed taxes, they didn't have online or e-filing. But I filed a 1040 easy form, sent it off, got my little $129 check, and I just thought I was big balling. So when you have income, and when you have taxable income, I should say, because there is a difference between non-taxable income and taxable income. One of the most recognized non-taxable incomes is people who receive VA disability. If you receive VA disability, that is not taxable income. And if that is the only income you get, you do not have to file taxes. If you receive only Social Security income, you and your spouse, no pension, no interest, no trusts, no royalties, only Social Security income, you do not have to file taxes. And that doesn't matter what age you are. So it's not really, like I said, an age thing, because if you're on full disability at the age of 25 and all you're getting is your Social Security disability or SSI, then you don't have to file taxes at the age of 25. Whereas a person who could be 70 receiving Social Security, but they get pensions, they have a part-time job, they're still filing taxes. So the best bet is to look at your income. Your income will determine if you have to file or not.
Okay, so let's just pause and remind everybody that we're WRWK 93.9 FM. This show is Finding Our Fit, and I'm Susanna Wu-Pong Calvert here with Marketia Wright, JD LLM tax professional, and we're discussing getting past the ick of taxes, the ABCs of the Internal Revenue Code. Our phones are not working, but we would love to hear from you listeners. If you're on Facebook, then pop something in the chat. we'd love to hear your story or question. I know you have questions for Marketia. I know I do. So speaking of questions, so I want to just back up to that your Social Security income, if that's all you get, is not taxable. But if you earn additional income beyond that, and probably most people do because it's so hard to live on Social Security, right? Then a portion of it can become taxable up to 85% is what I think you said.
Yeah, up to 85% of it can become taxable. Yes.
So how do you figure out what portion is taxable? Is there like a calculator on somewhere?
So there is, if you go on IRS's website, all the information that I'm giving you guys is located on IRS's website. But if you go on the IRS's website and you look under, I think you just type in Social Security and then taxable, they basically, they list it out. And one of the things that I found is that if you're an individual and your combined income, which is your Social Security plus any additional income that you have, is between $25,000 and $34,000, you may have to pay income tax on up to 50% of your benefits. If you make more than $34,000, up to 85% of the benefits. So there is a chart. There is something that is on. Sorry, my earbud keeps trying to come out. There is a chart or something that is on the irs.gov. You can ask the Social Security Administration, but 9 times out of 10, they're going to direct you to the IRS unless they're well versed in the tax implications of working as opposed to with Social Security. But there are charts out there to help you figure it out, saying, okay, this is how much I can make between, before it starts becoming taxed. And then also keep in mind too, if you have a second job, if they're taking taxes out, you still are eligible for your deductions. You are still eligible for tax credits. So there's still a way to eat up a lot of that tax liability that you may have to pay. So don't fear and thinking, oh, I just got to sit here and suffer because if I try to get a job, I'm gonna have to pay more taxes. No, you still are eligible for all the other things that people get who are just, regular working individuals. You're not, they don't go away just because you're retired. The only thing that you lose out on after you turn the age of 65 is you will even if you are working, you will no longer qualify for the earned income tax credit. Earned income tax credit is only for individuals between the ages of 25 and 65 who are working, keyword working. So if you do not work, you cannot get the earned income credit tax credit because it is in the name, earned income. So, yeah.
Okay, so you just said that the earned income tax credit, you can claim that up to age 60.
You could be eligible for it. You can be eligible for it up to age 65. There are some income limits and, household limits, but after the age of 65, you will no longer be eligible for it. But okay. The caveat to that is after that age, they will increase your standard deduction. So your standard deduction goes up. So last year, for single people, I think the standard deduction was $12,850. Those people who had reached that age limit, theirs was $14,700. So it increased about $2,000. So they take away the earned income tax credit, but they give you a higher standard deduction. So, yeah.
Okay. And the earned income tax credit, we sort of skipped over that pretty quickly earlier. That is for people at a certain income bracket. Yes. Is that right? For lower
income? You're at a certain income level and it goes based on your income and your household size. Normally, people who are single with no dependents normally do not qualify for it. In the past 2 years, due to the pandemic, there were those who may have qualified for it simply because they increased the limit with the American Rescue Plan of 2021. They increased that limit, but those that increase expired at the end of 2022. So there are a lot of people who were single who were eligible for the earned income credit, but they're no longer eligible now because of their income. But it goes based on your household size or how many dependents you have and your income limit. And so a good example of that is, hold on one second, pull that screen up. Okay. So a good example of that is if you are single or head of household, or you're filing widowed and you have 0 dependents, the income limit is $17,640. And what happens is it's done at a staggering thing. So you can be eligible for credit up to $7,500, but most people are not going to get that, but that's where it caps out. That's the most credit you can get. But I think for single people, it starts at like $540 and just keeps going down from there. If you are single, head of household, or widowed, and you have one dependent, the income limit jumps about $29,000. So it goes from $17,640 to $46,560, and you can be eligible for credit. If you have two dependents, it goes up to $52,918. If you have three dependents, $56,838. And this is for that filing status. Now, obviously, with married filing jointly, the numbers are higher because it's, two more people. So it's based on, like I said, the number of dependents, household size, as well as income on what you'll be eligible for.
Okay. So thank you for explaining that to me.
Mm-hmm.
I've never quite exactly understood that. Of course, I still don't exactly, but I have a better idea. And really this conversation is just giving me so much more of a frame of reference for what feels like just this black hole. Okay. So we have, less than 10 minutes left, but I'd like to, if you can cover these two items within the next 7 minutes or so, because I want to make sure there's time for you to tell people how to get in contact with you or learn more. Two topics. One is how to avoid paying a tax professional. Like when do you hire one and when do you not? When do you use like a product like TurboTax or something like that? I guess it's another version of it. And then also, what should you aim for in terms of your withholding? Is it better to break even? Is it better to get a refund? Is it better to pay a bit? Well, what's your take on those two?
Okay. So first off, with a tax professional, if you are single, maybe one or two dependents, one job, do not pay a tax professional. You can go to a TurboTax site. You can go, I think, Freedom Tax USA, especially if you're making less than $65,000. There's a VITA program, which is VITA, the Volunteer Income Tax Assistance. What happens is it's a program sponsored by the IRS, but they partner with nonprofits to host the sites. So you can go to irs.gov, you can type in VITA, you can type in where you're at, and they will give you a list of their partners who are holding VITA sites. And they have income limits, but usually I think this year was 60,000, but they tend to go up. And depending on the site coordinator, because I was one, if yours is a really, really quick, easy one and you haven't exceeded it very much, I'll do your taxes anyway, because I don't feel like people should have to pay to do their taxes, but that's another soapbox. But check out that program. They will do your taxes for free. Just bring in your documents. You have to make sure that you have your identity documents, your IDs and Social Security cards for yourself and any dependents you're claiming, and your tax documents. But if you must go to a tax professional, first off, make sure that person has a PTIN. And what a PTIN is a preparer's tax identification number. This means they have registered with the IRS, telling the IRS, I am going to prepare tax returns for compensation. It is a requirement if you prepare tax returns for compensation that you have a PTIN. You go to a tax preparer and you ask them what a PTIN is, and they look at you crazy, or they say, what's that? Run the other way. If you have a simple return, and when I mean simple, you got one job or you got a 1099 independent contractor, a lot of the tax software, it is user friendly if it's simple, and that you can just plug in your W-2 information, you plug in your information, any dependents information, and you just keep clicking through. It's a lot of just clicking through. I know TurboTax themselves, they have an awesome, and I'm not endorsing them, but they have an awesome customer service thing where you can call them, and while you're actually in the process of doing your taxes, they can remote in, they can see your screen. Once you give them permission, all they can see is your screen. They can't see anything else on your computer, and they can show you where to put the stuff in, and so that can help you with that. For those states that have state income tax, Texas doesn't, but for those states that have state income tax, the majority of the states that have state income tax will allow you to file your state return for free if you go to either their Department of Revenue website. I'm not exactly sure what it's called in all the states, but they usually will let you file your state income tax for free. If you have complicated taxes in that you have a small business, you have rental property, you sold some land, you sold some property, you may be eligible for maybe the residential energy tax credit, or specifically, I know people who took money out in 2020 for COVID, and now is in that 3-year point where they're trying to pay it back, and some people haven't filed for a few years, or you've gone a couple of years without filing. That is the time to seek out a tax professional, because things change sometimes year to year, and what you may have been eligible for the previous year, you may not be eligible for now, or there may be some additional things that you weren't aware of that you could qualify for that maybe you can't qualify now, but because it's still within that time frame for you to file, you still qualify for them. So in those instances where it's something that is beyond you just entering a W-2 or a 1099, you may want to seek out a tax professional, just because when you start getting into your Schedule C's and your Schedule E's and your Schedule F's and your Schedule 1, 2, and 3, like there's a multitude of documents that can be attached to your return. When you start getting to that, you really don't want to, I guess you could say, take a risk on that, simply because when you sign that tax return, the IRS is looking at you when they audit you. They're not looking at anybody else, because you signed that under penalties of perjury that you thought, to the best of your knowledge, it was accurate. And if you say, well, I didn't know because I didn't know how to do this, first thing I'm going to ask you, especially as an auditor, why didn't you hire a tax professional? And granted, some people, they can't afford it, and that's understandable. That's why they have the VITA sites. And the people who work at VITA, they are IRS certified, meaning they had to go through training and become certified to be able to do your taxes. They may have some parameters or some scopes that they may not be able to do, but for the most part, simple returns, you can go there, you can get it done for free. You can know that, okay, these people are trained and certified by the IRS. All right, and what was the other part of that question? I'm sorry, I went off on a little bit.
Just whether people should aim to get a refund or break even.
Now, me personally, I always say you want to break even, simply because if you're getting a refund, it means that you paid in too much money, and you gave the government an interest-free loan on your money. They're not going to give you interest. They're not going to pay you interest on that unless they don't return your refund in enough time. They do have a time limit to return your refund. You can't get interest that way, but that's just me personally. I dealt with some clients who both receive Social Security. They don't receive any of the income, but they pay taxes. And why? Because they want that refund every March. And they take that money and they say, we don't have the discipline to save it, but we know if we have them take it out, we're going to get a nice refund in March, and that's what we use to go on our vacations and stuff like that. Some people do that. They use it as a way to make sure that they're going to have a nice chunk of change in February or March and stuff like that. Personally, I would say breaking even. Them giving you $100, $200, $300, it's not too bad. Personally, I never want to owe, simply because if you cannot afford to pay it by tax day, you are now subject to interest. Your extension to file is not an extension to pay. Your tax liability is due on tax day, whether you have filed that return or not, or whether you file an extension. So I always say it's never good to pay. If you do have to pay, there are installment agreements that you can make with the IRS. You can go online, you can set up an account, and you can tell them, hey, I'm gonna put this amount down. I can pay this amount every month, and just take it out until the debt is paid. One thing that I like to tell people about the caveat is when you're doing the automatic payments, with some companies, if the automatic payment's supposed to come out on the 1st, but you have paid it off before the 1st, they won't take it out on the 1st. That's not the case with the IRS. If you pay extra or additional payments throughout the month, they're still going to take what you owe on that day, unless those extra payments have covered all the debt. So keep that in mind when you want to make extra payments. Also, if you are making payments and you do have an installment agreement, and the next year you owe more money, they are going to separate it by tax year. I don't think they bundle it all together, if I'm not mistaken, but double check that. But I don't think they bundle it together. So you'll be paying, you're thinking, oh, I'm paying $100 over all my debt. No, you'll probably be paying $100 to 2022, $100 to 2023. So double check with your payments how that's going to work, to make sure that you don't miss payments and that you don't receive any penalties or any additional interest from missing payments.
Okay. Well, thank you for that, Marketia. Very informative. Mm-hmm. And we just have about less than 2 minutes left for you to let people know how to contact you or learn more about you, or any other contact information you wish to share.
Okay. So I can be contacted. Email works best for me. I am an elder millennial, so I really don't like to talk on the phone. But email works best for me. You can contact me at marketia.wright@gmail.com. It's my first name dot last name @gmail.com. When you think about how to spell my name, spell market and then put IA on the end of it. So marketia.wright@gmail.com. You can contact me there.
Okay, wonderful. And I'll just remind people that they can also access education on how to become more resilient at the Foundation for Family and Community Healing website at healingedu.org. And I thank you, Marquita, for enlightening us about taxes and giving me a little more confidence
I'm glad.
as I am filing this year, and also for your service to the foundation. And so that pretty much wraps us up for this week, Ron. Thank you for ushering us through another week of Finding Our Fit.
Indeed, my pleasure. Well, so thanks a lot. Wave goodbye to your studio audience out there. Woo-woo. All right. Okay. All right.